OptionChampion.com.
Today is Saturday, February 18th. I'm Rick Adams, and this is Tricks of the Trade.
All data and other information contained throughout this video are for demonstration purposes only and shall not be construed as trading or investment advice or an advertisement for software or other trading applications, nor shall any part of this presentation be considered a recommendation of securities or other tradable products or related strategies. Trading and investing, whether short or long term, involve risks that may not be suitable for everyone. Any mention of past performance is not an indication nor a guarantee of future results, as volatile market conditions can arise at any time and result in substantial losses. No individual should make any trading or investment decisions without consulting a professional and conducting his or her own research.
Welcome to Tricks of the Trade on this post-expiration Saturday. Equity options are now off the board for the month of February, moving the March options up to the front month cycle. Cash market indices were mixed on the week. The Dow lost 43 points, the S&P 500 lost 11, the Nasdaq Composite gained 68, the Russell gained 27, and volatility ended the week lower by 51 cents. Crude oil lost $3.42 on the week. Gold lost $25.10, silver lost 29 cents, and natural gas lost 32 cents. This week's trade setup was in Cameco Corporation, symbol CCJ, on the New York Stock Exchange. Before we dive into the details of the trade, here's a quick chart analysis. Roll it. This is a one-year daily chart on Cameco, and I'm looking from April of last year to present. I'm looking at the price activity in order to determine what type of trade to put on in the stock. And one thing that stood out to me pretty quickly was the failed high on the wick tops. And what I mean by that is in April of last year, the stock reached a high of $32.49 per share. And from that point on, there's this roller coaster pattern here where the stock pulled back and then bounced, pulled back and then bounced, and so on and so forth. This roller coaster pattern, sort of this wild ride in this stock. And inside of this pattern, there are four candles in particular that I'm looking at. I'm looking at this one here, this candle here, this one here, and this one here. I'm looking at the wick top of each candle, the highest point of each candle. If I draw a trend line from the first candle to the fourth candle, we can see that at each wick top, there's a higher high. On the first candle, there's a high of $27.61. On the second candle, the high is $28.28. On the third candle, the high is $30.75. And on the fourth candle, the high is $31.29. So it's a higher high on each candle, which is sort of good in that it's kind of a sign of strength when there's higher highs. However, none of these highs break or even reach the April high of $32.49. So to me, that's sort of a sign of weakness. While there are higher highs on these candles, and as I said, that's kind of a sign of strength, it's not quite strong enough for me to consider taking a long position on this stock. And moving closer to present with this cluster of candles here, none of these wick tops here break or even get near the April high of 32.49, or more recently for that matter, the September high of $31.29. So looking at the wick tops from that perspective, here's $32.49 in April of last year. In September, there's a high of $31.29, which is a lower high, and then going closer to present. And just picking a couple of these at random here, $29.36, $29.54. Those are lower highs as well. So coming off of the April high, we have a lower high and a lower high. So, and added to that, the RSI is kind of in this overbought territory, although I'm not putting a lot of weight on the RSI. I'm just looking at the price activity. So all that being said, I think there's some weakness there at the top, and so I'm looking to make a play to the downside. And a play to the downside it was. The trade was a long put vertical spread in April with 63 days until expiration. The spread is $2 wide with the long put at the 28 strike and the short put at the 26 strike. I bought the 28 put for a $1.60 debit and sold the 26 put at an 86-cent credit. Putting the two together, I paid a net debit of 74 cents on the trade. On a long put vertical spread, the maximum risk is the debit paid, and the maximum profit is the width of the spread minus the debit paid. So on this trade, the most that I can lose is the 74-cent debit paid, and with it being a $2 wide spread, subtracting that 74-cent debit paid from that $2 spread gives me a max profit of $1.26 per share. Now, I'm only a couple of days into this position, so from a management standpoint, we'll see what transpires between now and expiration. That's it for this episode of Tricks of the Trade. I'm Rick Adams. Thank you very much for watching. See you next time.